So today, what I want to talk a little bit about is documents that are recorded. Documents that pertain to real estate, sometimes it can be kind of confusing. So we've got a deed, and deeds are called a lot of different things. Quick claim deed, special warranty deed, joint tenancy deed, community property deed. There's a lot of different types of deeds out there. What a deed does is it puts the property into your name. So this deed, and I'm going to say in your name in the interest of it's obviously your LLC. This deed conveys the property into your name. Now, a bank or hard money lender, okay, cannot lend money to you unless the property is in your name. The way the bank is protected is the deed of trust. I would write that down. It's in some states, it's called a trust deed, and I would write equals mortgage. That keeps it easy. That pertains to the mortgage. So what happens in a transaction is an attorney or an escrow officer is the one who gathers all the paperwork for the transaction. Okay, they always are working with the title company. Title company has an underwriter. Title company is saying, yes, I'm going to write insurance on this. I can give you an insurance policy on this piece of property, but because it's clear of all liens, there's no railroad easement going through the property, whatever the case may be. Okay, title insurance is very, very important because if 5 years from now you find out you really don't own the property, well, guess who's paying you? The title company. That's why they have insurance. So every attorney or escrow officer, depending on your state, works with a title company. The escrow officer or attorney is kind of the communication person. They're gathering all the paperwork. Title company may be telling them what paperwork they need. Like maybe there's a deed of trust that was paid off, but a release was never recorded. So the title company is saying to the escrow officer or attorney, we need to get this release. We need to record it. Okay. So the escrow officer or attorney now has all the paperwork that's about to be recorded. So the bank says, well, we can't lend to these people until they own the property. So they take the stack of papers to the recorder's office. Sometimes it's called something else. And it looks just like it's just a stack of papers. They record the deed. It gets a book and page or a reception number. Now, right now you own that property. The bank's happy. The very next document that's recorded is the deed of trust. That protects the bank. That protects your private money lender. You very rarely ever sign the deed unless you're taking title a certain way. It's usually it's the seller who ends up signing the deed. You sign the deed of trust. Now, another document that's always included in the transaction is called a promissory note. Promissory notes are not recorded. Promissory notes do not attach to a piece of property. It's just a promissory note that you're promising to pay back the bank or you're promising to pay back the hard money lender. So there are a lot of very ethical investors out there who will not provide a deed of trust to their private money lenders. I personally disagree with that because that private money lender is not protected. That they're not attached to a piece of property. They only have a promissory note. Now, the reason they do this is because they can move that money around in different projects. So I completely understand why they do it. I have specific language for my private money lenders if I'm sharing my private money lender with someone that they tell the escrow officer, do not disperse funds until the deed of trust has been recorded showing me in first or second position, whatever the case may be.